Everyone, welcome to tonight's session. We'll be discussing income in our tax law number 2 session. Since everyone will be certifying at the advanced level this year, the income section will include self-employment or schedule. We have a lot of material to cover, but Jared will be taking a 5-minute break about midway through the session. Please continue to put your questions in the chat. We will answer questions when we come back from the break and again at the end of the presentation. Just wanted to let everyone know we have not yet received the 4012s or the certification tests. I talked to the IRS today and hopefully we'll receive them within the next 2 weeks. So at this point, I'd like to turn things over to Jared.
All right. Thank you very much, Michelle. We will go ahead and get started with our program here. Appreciate everyone coming out. We have finally started to see some November weather here after feeling like we were still stuck in September here for a little bit. But it's going to feel a lot more like getting ready for tax season coming up. And we will start that by going through talking about our tax law training. What we're going to do is actually go through the slide deck that Michelle has provided for everyone. And again, if you have any questions during the presentation, please feel free to utilize chat. And we will attempt to record the session, so we'll have opportunity for you to review later as well. So I'm going to go ahead and stop my video here, but just want to make sure that you are seeing that I am live and being able to talk to everyone in person. So we will go ahead with our presentation. All right, so we are in our second session. We've actually moved beyond our first position here of the filing status and dependence, some of the tax law changes, and really want to get into a little bit more of the tax training itself in terms of the income pieces. Now, what we're going to be doing with this session today is we're going to be talking about the items of income that will normally be not only applicable for VITA, but also going ahead and looking at the situations that are going to be on your exam itself. So what are the things that we'll typically be looking at for the testing? So what we want to try and take a look at here is going through and identifying the sources of income. Again, because we're using this as a opportunity for everyone to certify at the advanced level, we're going to go through all the types of income that you may see on the advanced certification. So just a couple reminders. In the upper corner of your slide set, you will actually see we have a opportunity to identify where our information is coming from your 4012. So you can actually see in the upper corner some information there. And from that aspect, it'll give you an opportunity to review back and see where we are getting our information. So it'll allow you to do just a little bit more opportunity here in terms of referring back to your guideline. All right, so a couple things that we want to talk about here for taxable income. Most of our traditional items are going to be things like our wages, salaries, bonus, alimony. We have a couple other things coming in with annuities, business income, forgiven debts, dividends, any type of employer-funded disability benefits gained from the sale of property, things like gambling winnings, interest, IRA distributions. We're going to also talk about some other items of income like jury duty fees. We're going to cover military a little bit later in our sessions as we get to our military training. One of the new things that we're going to see here is the non-employee compensation. This is going to be reported on a new 1099 NEC. Now, the practice lab does not actually have the new entry yet. It is expected to be coming out at some point here soon, but we don't actually have that in the current iteration of the practice lab. The other things that we're going to be taking a look at are areas of pensions. We'll talk about those tonight. We don't often see the concept of refund of state taxes. We will talk about that in connection if you had a itemized deduction in a prior year. But if we do have individuals that are receiving state refunds, if they did not have itemized deductions in the prior year, we really don't have to worry about those refunds. Rents are technically out of scope for VITA, but they are considered taxable income. So if you do have a taxpayer that indicates that they do have rental income, it may be unfortunately precluding them from preparation within VITA. We will talk about Social Security benefits, and one of the big ones you'll see at the bottom here is unemployment compensation. given where we're at for the 2020 year with the increase in unemployment compensation, our general thought is we're going to see a lot more of 1099-Gs than what we've seen in the past. So just want to go ahead and talk about what those are going to look like and give you some additional information about how do we report and cover those items. Okay, so what are some areas that are considered non-tax? Well, this is always an interesting issue as well, because in addition to what is frequently taxed, we also have a number of items that people ask, is it actually going to be, how much do we have to pay in taxes? Things like child support, damages for physical injury. This would be in case you're getting compensation for physical pain, medical treatment, those types of things. Federal income tax refunds. So if they got a refund in the prior year, or technically if they had received the economic impact payment, that would also be tax-free. Things like gifts, inheritances. So if oftentimes we have someone coming into VITA and asking, well, I received some money from an uncle who passed away. What would that look like? Well, fortunately, those aren't taxable. Any gifts or inheritances are not taxable. Same thing with insurance proceeds. Oftentimes we'll have some tax-free interest on securities. Those are generally going to be shown in the brokerage forms, so we don't really need to worry too much about those. If we have sickness and injury payments, generally the rule of thumb is if you're paid because you cannot work, physical injury or sickness or things like that, that income's not taxable. If you're paid to not work and you're eligible to work, like unemployment, that is considered taxable items. So things like our supplemental security income, SSI, is non-taxable, veterans benefits, welfare payments and food stamps, and workers' compensation. So again, if you're being paid for on account of injury or sickness, typically not taxable. If you're receiving items such as unemployment benefits or being compensated, that would be considered taxable income. And just as a review, a couple of the common things that we'll be seeing here within VITA typically are going to be showing up on our Form 1040. These are going to be things like our wage income, usually shown on line 1, interest income coming off our 1099 INT, our dividend income coming from our 1099 DIV, and coming back again, we have 2 lines for the IRA distributions and pension and annuity distribution. These are going to be 2 separate lines on the 1040 again this year. If you recall, in the past, they had been combined to 1, but we are back to 2 separate lines. Social Security benefits will be showing up on our 1099 SSA, and those will be ultimately flowing to line 6A of the 1040. The Schedule 1's a little bit different again this year, always a few little tweaks in terms of where these will actually show up. If they have a separate line or not, they will all flow to the front page of the 1040 and be calculated within our taxable income. A couple things you'll notice with our alimony received, that would be in Part 1 of our Schedule 1, line 2A. The other thing that is relatively new is the date of divorce. And the reason why is because divorce proceeds, when we talk about alimony rules have changed if we had divorces that have occurred after December 31st, 2018. So kind of an important date if we have someone who's been with VITA for a while, unless their alimony has substantially changed or was resubmitted by the courts. Typically, if they had taxable alimony before, they will still have taxable alimony now. It's only for divorces that either were completed or substantially changed after that December 31st date. And the big one we're going to be taking a look at here is going to be our unemployment compensation. That one, I believe we're going to see a lot more than what you may have experienced in the past. So the unemployment compensation will show how that's going to be working, how we enter that. That will show up on Part 1, Line 7 of your Schedule 1. We also have some other income items that we'll just briefly mention, things like, again, going through, taking a look at our opportunities for jury duty pay and a couple other things. Another area that I just wanted to discuss with you here is all the common forms, what they're going to appear. As you can probably tell with your experience within VITA, all of the W-2s have the exact same boxes. However, they're not always in the same order. So this is a traditional W-2. Usually you'll get 4 copies of these W-2s from the taxpayer, but the basic information will all be the same. We always need to know what the employer identification number would be. So that is typically up in the box B that we go ahead and take a look at there. So let me see if I can help identify that for you. So that would be our employer identification number. We always need to enter these. The nice part is, again, if the taxpayer is coming back from after having returns prepared in VITA, that information should carry over. Once we identify the employer identification number, if we have done this for another company for the same year, their information should pop up. We would simply enter that information into TaxSlayer if it's not already there. Just want to double check that we're using the appropriate Social Security number and indicating whether it's a taxpayer or spouse. Then what we want to take a look at is obviously the information coming in off of the W-2 itself. So these would be our areas of compensation, things like our federal taxable wages and our federal tax withheld. Just bear in mind that we will try and go ahead and have TaxSlayer wants to go ahead and fill in Social Security and Medicare wages. If we are preparing returns and an individual does have items that are deductible for PA, such as, or I'm sorry, not deductible for PA, like their retirement plan contributions, we're going to see that we have a difference in state wages. So just bear in mind that these wages may be higher than our federal wages. You will get a diagnostic for that within TaxSlayer, but as long as we know what the difference is, we should be fine to go ahead and ignore those. As a reminder, anything that you enter in the box 12s will automatically carry over to the appropriate line if needed for TaxSlayer. Anything in box 14 does not flow anywhere else in the return. So just want to point out a couple of those items. We will cover a little bit more with your state entries when we get to the state and local tax section, which will be coming up in session number 4. A lot of these other forms are going to look very familiar since, again, they didn't really change from prior years. The 1099 INT, traditionally, we're going to take a look at box 1. As we see here, the individual had $56.20. Most of you who have a savings account probably realize $56 is a lot of interest income. It's a very significant amount that they would actually have in the bank, and we're probably not going to see a lot of interest income at relatively high levels within VITA, mainly because the interest rates are incredibly low at this point in time. The other thing I just want to point out is that if we have less than $10 of interest income, the financial institution is not obligated to issue a 1099 INT. So oftentimes you may have a taxpayer who is concerned about reporting their income, and they want to go ahead and write in the fact that they had $2.12 of interest income. By all means, you're allowed to go ahead and put that on the return. However, it most likely will not make an impact in the tax return calculation. And they may ask why they did not get a 1099 INT, but the main reason is because it was under the filing threshold. While we don't often see those, you do just want to take a look at box number 3, which would be interest on U.S. savings bonds, and also box number 4, which would be in case they had any federal income tax withheld on your 1099 INT interest income. Just want to point out a very basic 1099 DIV. If we do have dividend income, it could come through either in a single 1099 DIV. In this case, we're seeing one coming from Edward Jones. We have a amount of ordinary dividend income in 1A. We have our qualified dividends in 1B. And in this case, we have a capital gain distribution, which happens quite frequently with mutual funds or other types of investments. So again, what we want to do is simply go over to the dividend section and enter the information as we see it from these schedules. The other way we may see these is a consolidated broker statement, and we'll talk about some entries there because we may see not only dividend income, but also capital gain activity as well. As a reminder, we can go ahead and enter the information effectively in a summarized format to make it a little bit easier for data entry and to avoid input errors as we go down through the process. One of the other forms that we'll be seeing here, I believe a lot more in the 2020 year, is going to be unemployment compensation. Fortunate part, the first one who's going to enter this for VITA is going to go ahead and enter all the information, including the PA unemployment office on Boa Street in Harrisburg. Once that information is entered in, it should pre-populate for everyone else. And the key areas to take a look at are going to be box 1, which is unemployment compensation. So all unemployment received by an individual within Pennsylvania is considered taxable for federal purposes. It is not taxable for state or local. Hopefully, the taxpayer had elected to have federal income tax withholding. The default rate is a 10% rate of withholding on unemployment benefits, which happens to be the lowest tax rate possible. With the additional amount of stimulus money coming through unemployment compensation, We may be seeing much higher than normal numbers with unemployment. And as we're going to be talking about as we finish off with the process about how do we deal with clients who owe, this can be one of our main issues, taking a look to see whether or not their withholding was adequate to cover their taxable unemployment compensation. So we'll talk about a couple of those items as we go through the process as well. Another popular common form is going to be our SSA 1099, which is our Social Security benefit statement. This is going to be providing a number of pieces of information for us. The majority that we want to take a look at, the critical element, will be the amount that is going to be in box number 5. It is in a relatively pinkish, maybe salmon hueish color. I apologize, I'm an accountant, not an artist, so my color skills aren't that great. It is a shaded box here that will go ahead and indicate the amount of taxable benefits, or I'm sorry, not taxable benefits, net benefits subject to tax for the taxpayer and or spouse. That's the amount we're going to enter into the Social Security benefit input area. In addition, we just do want to check and see if we have anything in box number 6, which would be our voluntary federal income tax withholding. The other items that we could take a look at here as well are usually in box 3. There will be an indication of how much the taxpayer has had in Medicare Part B, Part D benefits. We can actually input those as well right in the 1099 SSA screen. They will automatically flow over if they are eligible for itemized deductions as a medical cost. One of the other areas that we have is our 1099-Rs. These are going to be issued based on distributions from a retirement plan. Again, we'll talk a lot more about these in the next couple minutes, but just wanted to reiterate what these will look like. We do have a number of boxes to consider. One is the total gross distribution in box 1. Hopefully there will be amount in box 2A. If there's not, we're going to talk to you about how we can work with those. A couple things to keep in mind with this one as well. Hopefully we will see an amount for federal income tax withheld if the taxpayer normally has a retirement distribution that's subject to tax. Hopefully that they have already had withholding to prevent them owing money down the road. Other areas to keep in mind are going to be down here in box 7, and that will include box 7 and the actual checkbox immediately right next to it. So what we're going to take a look at are the box 7 and whether or not it's indicated as IRA, SEP, or simple. Main thing will just be box 7 will determine the taxability and or penalty application. And the IRA SEP simple will just indicate where that information will actually end up on the 1040 itself. We'll talk about another couple boxes. 9B may be applicable as we talk about a process called the Simplified method. We won't always see those, but I just want to point out that that could be a possibility as we move through our activities here. A couple things I just wanted to point out, and again, for reference, this is found on D40 of your 4012, are the common 1099-R codes for retirement. The best ones we could possibly have are code 1, which is a, the worst one we could have, I should have started off going the worst to best, is a code 1, early distribution with known exception. Typically what these are individuals who are underneath the retirement age of 59 and a half. They've decided to take out their retirement distributions early. Maybe it's because they've terminated a job. Maybe they have gone ahead and needed to take money out of their IRA. Typically, the code 1 is going to indicate that that distribution is going to be subject to tax, as well as subject to a penalty at the same time. So in general, all the codes, anything coming through a 1099-R will be subject to tax. Mainly what we want to take a look at is whether or not there's any application for penalty as well. Code 1, definitely not a good one to have. Usually when you see these, we may have to do a little bit more work with the return and determine how that's going to end up impacting the rest of their tax owed, or maybe reduce their refund. In addition, this will be considered taxable for state and local purposes. So a code 1 distribution will be taxable as well for state and local. The one benefit we have is that the cost basis is going to be recovered first. We'll talk a lot more about that when we get into the state and local section, but just want to reiterate that there are no substantial changes in 1099 taxability for the 2020 year. One thing we may see a little bit more of this year is a code 2, an early distribution, but an exception to the penalty applies. So this is an opportunity for someone who has taken a withdrawal from a retirement plan, but has already received the forgiveness for the penalty provision from the third-party administrator. They provided a valid reason why the distribution occurred, and if we see a 1099-R with a code 2, it's going to indicate that there is no penalty to be assessed on that distribution. All right, so we're going to take a look at code 2. That, again, because we're underneath the retirement age, that will also be considered taxable for state purposes. And again, we'll talk about how we recover cost basis. 3 and 4 are due to either disability or death. Usually a beneficiary of a retirement account will be getting a code 4 that is also going to be taxable for federal purposes, not taxable for state purposes. Couple ones that I just want to point out here. Technically, these are not in scope within VITA, the code 6 and the code W. However, they're fairly basic areas to work with. So I just want to point this out again. It will not be on your certification exam. You may run into these, particularly if you may be doing your own return or friends and family returns. The wrinkle we have with code 6 and W is that these are really code 6 is really a tax-free exchange of an annuity or insurance policy, and a code W is using retirement funds to purchase long-term care insurance premiums. Really nothing special on the federal side, but I do want to mention that from a state and local tax perspective, particularly for the state, it may impact things like the tax forgiveness program for Pennsylvania and also the rent rebate claim as well. So just watch out for those. If you're preparing returns that have the state rebate for property or homeowners. Hopefully the ones that we're going to see the most of are going to be these code 7s. That's our normal distribution. I apologize for the time it took us to get to the one that we actually enjoy the most. That is our traditional distribution from a retirement account, generally used by those who are already retired. One of the other areas we take a look at once we get into these lettered numbers, or the lettered codes, we actually have a G, which is a rollover from one account to another. Code H is a direct rollover of a designated Roth account, and a Q is a qualified distribution from a Roth. These will be non-taxable activities. The other thing that we have is a 7D, which comes up quite frequently on a couple annuity type investment accounts. The 7 indicates that it's a normal distribution. The D indicates that this is actually interest earned on a non-retirement annuity. So the little trick we have with this one is the amount that is considered taxable will be taxable for Pennsylvania purposes as interest income. Again, we'll remind you of that once we get to the state and local section, but just wanted to make a comment here for that. So I have a couple other slides that go through and help explain where we're at with these. Again, the code 7D are going to be taxable for Pennsylvania as interest income. The same thing, again, we don't see a lot of these, but if you have a charitable gift annuity, code F, that would also be taxable for Pennsylvania as interest income. Distribution code 4, again, traditionally coming from a account where you are a beneficiary. So no early distribution penalty applies, even if they're under 59.5. And the benefit there is it's not taxable for Pennsylvania or local, very similar to a normal distribution from a retirement account. Again, taking a look at code 6 and code W, these are very specific transactions within either an exchange of a life insurance or annuity, or using proceeds to go ahead and purchase long-term care insurance. What we're looking at here is that those are typically going to be tax-free for federal potentially, but the impact is really going to be on the Schedule SP and the PA 1000. A couple other things just as a reminder that we have with the pensions and annuities are going to be any type of distribution from a 401k, 403b, or a governmental 457 plan. The difference really is a 401k is our traditional for-profit employer. 403bs are traditionally nonprofit employers, including hospitals and colleges, and a 457b plan is a governmental plan. Traditionally, these are going to be taxable in full as individuals receive the funds from those retirement distributions. The only thing we're going to take a look at is whether or not we have some after-tax contributions made to these plans, and we're going to talk about the simplified method in just a little bit. One other area that we may have an exception for the full taxability would be what we consider a exclusion for insurance premiums for retired public safety officers. If you have a retired public safety officer, those that have been working in areas such as fire, medical, police departments, those types of things, we do have an opportunity for them to exclude the lower of either the premiums they pay or $3,000 for insurance premiums for health, accident, or long-term care premiums. If you run into this situation, if you take a look at the 1099-R entry in TaxSlayer, there's actually a small button right near the entry that says calculate your taxable amount, and that will bring up the next screen for the retired public safety officer's exclusion. There's also a very nice detail within the 4012 of how to enter this information if it applies to your clients. The other thing that we may have is we may run into issues with partly taxable retirement plans or annuities. And we'll be talking about that one in a little bit more detail. We may be taking a look at the simplified or general rule method for those calculations. A couple other things on the retirement plans itself. What we want to take a look at here is the taxable amount typically reported on the box 2A on the 1099-R is automatically going to flow to the form 1040, either line 4B or 5B, depending on whether or not we have a checkbox in box 7. Where we run into a little bit of an issue is where we see that box 2A is blank. What we hopefully are going to see is that there is either an amount in box 2A. If there is an amount in box 2A, that's the amount that we enter into TaxSlayer that automatically will carry over. If there's no amount in box 2A, what TaxSlayer wants to do is to treat the amount of gross distribution as fully taxable. One thing we may want to inquire with the client is to whether or not they've made any contributions with any pre-tax dollars. So if all of their contributions to their own retirement account were made with pre-tax dollars, we're in good shape. That entire distribution is going to be taxable. There's no reduction at all for pre-tax dollar contributions. However, if the taxpayer made a contribution with after-tax dollars, then we may run into a partly taxable distribution. And we're going to go through a couple rules to determine whether or not a simplified method can be used, or we have other options that we can take a look at. But if we don't fall under the simplified rules, this becomes incredibly complex and will traditionally have that return fall out of scope within VITA. We are seeing a number of Roth IRA accounts or Roth 401k accounts that are now being distributed. Generally, a Roth distribution are going to be tax-free as long as the recipient meets the following criteria: that they make a distribution at least 5 years or more after the first contribution was made, and the distributions after they turned age 59 and a half, or it's due to disability, they are an estate beneficiary, essentially they've inherited the account, or they're going to use it to pay certain first-time home buyer amounts. If those tests are met, we're actually going to go ahead and see those codes appropriately reported on the 1099-R. If we get a different code indicating the Roth IRA could be partly taxable, then we can run into some additional issues. And again, that will most likely be outside scope for VITA. A couple other things I do want to talk about here as well. When we talk about these partly taxable pensions and annuities, this is where we're not going to see something on box 2A. And quite often we're going to see the box checked right next to 2A to say taxable amount not determined. One thing we want to take a look at is to see whether or not they had an investment in their pension or annuity contract. Where we're typically going to see these is if you take a look at a 1099-R, they should be showing up here in a environment where it is going to be shown up on box 9B. So these are going to be premiums, contributions, or other amounts paid with after-tax dollars are going to be reflected on 9B the first year that the payments are received. This is going to indicate to us that we should probably be using the simplified method. And the simplified method is going to be used under either of the following circumstances: that the annuity was started after July 1st, 1986, and the simplified method was used to figure an amount in a prior year. So effectively, if we have been using the simplified method before, we simply continue with that. Or if the annuity started after November 16th, 1996, again, we should be in pretty good shape since that was over 14 years ago. And both the following apply: that the payments are from a qualified employee plan, qualified employee annuity or a tax-sheltered annuity plan, and at the starting date, the recipient was under age 75 or the number of guaranteed years is fewer than 5. So the area that I see this a lot more closely in is for retired government employees who actually have contributed to their own pension or annuity program with after-tax dollars. So these first contributions will be shown in box 9B, and that would be indicating that we could actually use the simplified method. A couple other things I just want to mention here. If we do have investment in contract and the simplified rule cannot be used, then we can use the general rule. It is a lot more complex, but Pub 939 will go through that process. Again, we probably won't see a lot of these in VITA. If you do run into one, be sure to go ahead and ask for help if you have not seen one before. The simplified method is a bit interesting the first time you walk through it, but overall, once you have some experience, it's really not too bad. So we just want to talk a little bit about what that simplified method would look like. So if we have been using the simplified method, hopefully we have the prior Form 1040. It's going to go through the calculations for us and show us how much was actually reduced from the taxable amount. Other things we're going to need are the details of the annuity payment program to determine how much is guaranteed and whether it's a single or joint life annuity. We also need to know the age of recipient at the start of the annuity payments. And if it is a joint life annuity, we need to have the ages of both recipients. Fortunate part within our process here at VITA, we will have the birth dates for both taxpayer and spouse. So hopefully we should be in pretty good shape from that aspect. One of the other things we want to take a look at is, again, taking a look here at our net investment in annuity. Again, those are generally going to be shown in box 9B. For the most part, when we enter simplified method in TaxSlayer, we're just using a couple different pieces of information. We could calculate this by hand, but actually when we go in and enter the information inside TaxSlayer, it's actually a relatively straightforward and simple process. So those are going to be some things that we would take a look at of how that would be entered in. Really what I just want to kind of discuss here with you is really taking a look at how we would determine whether or not we should be using the simplified method. And what we're going to take a look at here is when this would actually come into play. So what we have here is we have Bill Smith, age 65. He started receiving a retirement benefit in 2020 under a joint and survivor annuity. Bill's starting date was January 1st, so he's been retired the entire year. Benefits are paid on the joint life of Bill and his wife, Kathy, who's also 65. Bill had actually contributed $31,000 to the qualified plan. Again, these are after-tax dollars and had received no distributions before he started the annuity. What I want to just go through this example is to show that Bill's going to be receiving a retirement benefit of $1,200 a month, and Kathy's going to get $600 a month if Bill passes away before her. So one question we'd have is, would this be an example where the simplified method could be used? So what we would see here is we'd be getting a 1099-R. We'd be seeing an amount in box 1 that would indicate how much that Bill has received for the year. We'd also see an amount sitting in box 9B of $31,000. So based on the information, and again, a little bit different this year because we don't really have the ability to directly interview a client, but would be something we'd probably want to inquire to find out if this was a annuity that Bill had started for the first year. And if that's the case, we simply enter the information once we get it from the client about their ages, which we already have in TaxSlayer. We're going to enter the amount from 9B, and it should calculate the simplified method already. Now, we could also take a look at our information within our publications about how we would calculate it. But fortunately, in TaxSlayer, the information is relatively easy to enter. All right, want to move over to moving from the things that are relatively fun and easy to work with to the things that are a little bit more challenging in some aspects. And these are the early distributions from retirement plans. So one of the areas that we're going to see, we are going to typically understand this by seeing the code 1 in box 7. Again, this is an early withdrawal from a retirement plan. Generally no known exception by the third-party administrator. The taxpayer is under 59 and a half. Typically, we're also going to see that the total distribution box in line 2B is also checked. A lot of scenarios where this comes from is when an employee, again, separates from service. So if you leave an employer One of the questions that HR will have typically for that terminated or employee who's no longer with service is, what would you like to do with your retirement plan dollars? Your choice A is to go ahead and roll that over to your own IRA. Choice 2 would be to go ahead and roll it over to your new employer if they're willing to accept rollover contributions. Or choice 3 would be for you to go ahead and take the cash now. We do see a lot of people that choose option number 3, that they would prefer to take the cash now, particularly in the economic situations we're in. Quite often people will go ahead and take the money out of their plan at separation. So what's going to happen is the full amount is going to be coming out of their plan. It's going to be a complete total distribution. The entire amount will not only be subject to tax, but it also includes an automatic 10% penalty. If there's no other opportunities to have the penalty waived, it will automatically be included in the return, and there's no need for the Form 5329. These are going to be a little bit more challenging to work with, only from the fact there's nothing new on the entry piece. But again, we may be seeing a little bit higher amounts that people owe for taxes at the end of the year. This will be usually taxable for Pennsylvania local as well. We'll talk a little bit more about that in a second. But hopefully the taxpayer had opted with the automatic 20% withholding. When you take an early withdrawal from a retirement plan, the third-party administrator generally will have 20% withheld unless the taxpayer has elected out of withholding. That's not a good situation. Hopefully we're going to see federal withholding on any type of early distribution. So even if they do have a valid reason why the withdrawal had occurred, it only will eliminate the 10% early withdrawal penalty. It does not preclude the amount from being considered taxable income. So even if they have a reason why that the money had come out and it's a valid reason, it's only going to impact that 10% penalty, not the taxable amount. For state purposes, we're going to go ahead and take a look at the impact here. Again, we'll review that a little bit more in the state and local section. But Pennsylvania is going to go ahead and consider an early withdrawal additional compensation. Local is also going to go ahead and treat the same amount that we reported to Pennsylvania as other income. One advantage we have here in Pennsylvania is that when we take a look at those W-2s, when we take a look and your state wages are traditionally higher than federal wages, it's because Pennsylvania does not allow a deduction for an employee contribution to a retirement plan. So any amount that comes out of the plan that relates to the employee portion, the employee contribution, are considered tax-free. They're also deemed to come out first. So if we had, for example, a plan that had a $8,000 balance, 4,000 of those were contributions by the employee, 4,000 were either contributions by the employer or earnings on the plan. So an $8,000 account, 4,000 contributed by the employee. If that employee takes out 3,000 from the plan, 3,000 would be considered taxable amount for federal purposes and show up on generally box 2B. But for PA purposes, we can recover the first $3,000 are all considered coming out of the employee contributions. So there would be zero amount reported for Pennsylvania. If instead, if the employee had cashed out the entire amount, we're going to have an $8,000 taxable distribution from federal purposes, $8,000 subject to the early withdrawal penalty. And for Pennsylvania purposes, because we can recover the 4,000 of employee contributions, only 4,000 would be reported as PA compensation and also flow over to the local return, which we would need to enter by hand. So that would, I should correct that, it doesn't automatically flow. We do need to be sure to update the local return to account for those distributions. Now, what are some good news? There may be some penalty relief. And again, when we take a look at penalty relief, this is only to eliminate the 10% penalty. It does nothing to go ahead and prevent that from being taxable. One of the first things we'd see is generally these are going to be in codes on the 1099-Rs themselves. So it could be a distribution from an IRA that was converted to a Roth that gives the opportunity for someone to convert their account, not subject to a penalty. If you have an IRS levy, that's a code 2, again, not subject to a penalty. If it's due to inheritance, again, a code 4, not subject to penalty. If they're totally and permanently disabled, we may need to complete the Form 5329, and we'll show how that will work. One other area that could come into play is an individual may go ahead and pull money out of a retirement account, and instead of having a direct rollover, which would be a code G on the 1099-R, they decide to pull the funds out of the plan and then themselves go ahead and set up a new plan. So these can either be a full or partial, what we call indirect rollover, meaning it doesn't go from the plan to another plan. It actually goes from the plan to the taxpayer back to another plan. As long as that is done within 60 days, and the 60 days is a hard and fast rule. 61 days will not count. It has to be exactly 60 days. You can actually indicate that that was a rollover in TaxSlayer. So the 1099-R is going to show up as a code 1, assuming it's fully taxable, subject to penalty. But if the taxpayer rolled it over, we can actually enter that in the TaxSlayer and prevent the tax treatment. Another thing we can do if the taxpayer has a valid reason why the early withdrawal penalty should not apply, we can actually go under the other taxes, tax on early distribution. It's within TaxSlayer, and we can enter the amount that's exempt under the early distribution, exempt from 10% penalty, and then we have to select a reason from the drop-down box. And the possible ones that we would take a look at that typically we'd see within VITA would be a code 5, a 05. That is for any unreimbursed medical expenses paid during the year that actually exceed 7.5% of AGI. Again, all these codes are going to be found on H5 of your 4012, but that's a fairly substantial amount of unreimbursed medical expenses. Again, it's anything that would normally be deductible on the Schedule A, but instead, what's going to happen, they're going to be used to reduce or eliminate the penalty for early withdrawal. A code 07 is an IRA distribution. Again, this is only from an IRA for distributions for health insurance for unemployed individuals. A code 08, again, only for an IRA, is any distribution made for a qualified higher education expenses. So if someone's pulling money out of a retirement account, only if it's an IRA, and that money is being used for qualified higher education expenses, tuition, fees, books, supplies, any of those enrollment fees or the room and board, that will be eliminated from the penalty position. The problem it also does is it also will reduce your amount of tax-free scholarships, grants, and any other opportunities. So if we take the code 8, that may impact our ability to take some of the credit as well. So what we have to take a look at is what's your net amount of qualified higher education costs. Again, we're going to reduce those by any scholarships or grants or anything else you receive, but they can also impact the amount that we get to take for our education credits, which we'll talk about next week. Code 09 is an IRA distribution for the purchase of a first home. Again, the IRS is a little lax on what a first home rule is. It's essentially the first home you've had either ever or in a while. But you can take up to $10,000 for the purchase of a first home. Again, it will be subject to tax, but not penalty. One other item that's new is that the IRS does grant a exception to the penalty for up to $5,000 from a retirement account to help with the birth or adoption of a child. So one of the things we may find if you do have a early withdrawal from a retirement account, generally the recommendation from VITA is to ask the client what they used the money for or why they took the money out of their account. If their answer is, well, we just had a new child within the last year or adopted a child, then we have the opportunity to take a look at code 12 here, which again, any other items, but the new one will be our birth and adoption of a child. We can exclude up to $5,000 of that distribution from the penalty phase, as long as it was used within 1 year after the birth or adoption of a child. So again, the main things we want to take a look at here are what are the impacts, what actually was that money withdrawn for, and based on their response, does a penalty exemption fit? We don't want to go the other way around and necessarily kind of offer a lot of these penalty exceptions and see if they can try and work their way into the penalty relief. We just want to see if what they've already done with the distribution could qualify to eliminate some of their tax burden they may have with the returns. Now, a couple new things that are coming in from COVID. There are a couple changes to distribution rules, and these were found on the 4012 D35. Now, if you have a withdrawal from a 401k, 403b, or an IRA in 2020, you may be eligible up to $100,000 of distribution without being subject to the penalty. So you may be able to avoid the 10% penalty here for early withdrawal. Now, there are very, very specific criteria as to what this is going to apply for. So the first scenario would be that the individual who's either diagnosed or their spouse or dependent is diagnosed with COVID-19. So very specific definition. It is a diagnosis of COVID-19. Or that they can experience adverse financial consequences as a result of the individual, the spouse, or a member of their household either being quarantined, furloughed, or laid off, having work hours reduced to COVID-19, being unable to work due to COVID-19. If they own a business or they operate a business and they have closed or reduced hours, that can be impacting. If they have pay or self-employment income reduced due to COVID-19, or if they either had a job offer and they either delayed the start date or the offer itself was rescinded, that can be an eligible opportunity for the penalty relief. Because these are traditionally going first through the third-party administrator, we would typically expect that the third-party administrator would be going ahead and indicating a code 2 on the 1099-R, indicating that that distribution has already met the criteria imposed by the third-party administrator, and that you have the ability to receive the income taxable, but with the 10% waiver. And we're going to talk a little bit more about a few other things. There are a couple other changes to the COVID-19 distribution. These, unfortunately, are going to be out of scope for VITA, but if you do take money out of a retirement account early, you have an option to repay that amount back over a 3-year period. There's a special form that we would be using to do that, but for VITA-based clients, this is considered out of scope unless they have repaid that amount in full before the return is filed. So we do have one other opportunity there that is designated in the 4012, but because we are not able to prepare those returns, we are not going to spend a lot of time covering those for the VITA exam. A couple other things I just want to mention kind of related to retirement aspects are Social Security and railroad benefits. So typically what we're going to see for Social Security benefits, relatively straightforward. These are the SSA 1099s, so you would simply enter those exactly as they're reported under the federal section income under the 1099-R, SSA 1099 area under the Social Security benefits RRB 1099, or you can just search keyword SSA to go ahead and enter those. If an individual has railroad benefits, be cautious, we may be seeing 2 different forms. One would be the Railroad Retirement Benefits Tier 1, which is an RRB 1099, also known as the blue form. That is almost similar to a Social Security form. We're going to enter it the exact same way. The one we do want to watch is the Railroad Retirement Tier 2, which is a second form. And probably the fault of the government for calling it almost the exact same thing. It's an RRB 1099-R. This is also known as a green form. That has a separate entry into TaxSlayer. And if you have a blue form and a green form, you need to enter both. If you have the green form, just simply go ahead and follow the instructions on how to enter it. Again, that'll be found under the income section where we normally have retirement distributions. It's going to be under the RRB 1099-R, or use the keyword RR for railroad retirement. Again, that information is going to be found on the D44. All right. One thing I may want to do at this point, Michelle, is to go ahead and take a quick break so we can catch up with questions, if that's all right for everyone. We are just about an hour into the presentation here. We have about 10 or 11 slides left, so thought this might be a good opportunity to take a quick break, gather some opportunities for questions, if that would work for all. So I would be happy to start our 5-minute timer now. And go ahead, and if you have questions, feel free to load up our chat, and we will go ahead and address those shortly after we get back from break. So why don't we plan on meeting back here at 6:32 for our break.
and Jeff will provide us with a 30-second warning.
Okay. Thank you very much, Jeff. Did you want to go ahead and go through the questions we have so far?
Sure, let's do that. Thanks everyone for the questions. Again, please use the chat for any questions you have. So the first question is, are there estimated taxes owed quarterly for local, similar to state and federal?
Yes, if the taxpayer does owe local taxes, the local government would prefer that estimated payments would be made. Typically, those situations may be falling under self-employment activities, or if the individual works for an employer that does not withhold local taxes, the local government would prefer that you file local estimates as well if you're filing already with federal and state.
Okay. And I think there's a payment portal, or you could mail in those payments, correct?
Correct, yeah. So you can actually go ahead and do those on a quarterly basis. We'll probably just mention that again for the state and local section, but the one for Lancaster County is the lctcb.org, which probably sounds like a very bad Wheel of Fortune solving puzzle here, but you can get more information about how to file the estimated payments through that method as well.
Okay, thanks for that. The next question, it was a comment really, I did not see the 1099 NEC in the practice lab. So I can cover that. You're right, it isn't there yet. They intend to wire it in. If you're looking to progress your test case, you could enter that client's income in the conventional 1099 MISC under non-employment conversation, or just enter it as other income. And the calculations will still flow through. Next question, under CARES Act, early distribution of retirement penalties will be waived. Would that appear on the 1099 form? So I think it's more, Jared, where would we code that in the 5329 exception form?
Right, so what we would be looking at here, if the distribution is considered qualified from the third-party administrator, we would typically see that as a code 2 on the 1099-R. That would be box 7 code 2, that the penalty has already been determined to be not applicable because they have provided the information necessary to the third-party administrator for a COVID-related distribution. If it's still showing up as a box 1, that might be an opportunity to inquire from the client why they had taken the money out. And again, the restrictions are fairly limited here as to what those are going to be. They either have to have been diagnosed with COVID or can show an impact from the COVID related shutdown that the funds were actually qualified. But we could theoretically fill the form 5329 to eliminate the penalty if that does come through.
Yeah, and then I'll just let the team know it's actually one of the test cases that a client takes an early distribution because of he's out of work due to COVID. It's coded as a box 1, so you would need to choose that other category in the 5329 to reverse out the penalty.
Right, and one other area there as well, just while we're on the COVID-related distributions, Jeff, if you take a look at the Form 4012, page D35, it actually covers a lot of the criteria for the COVID-related distributions from a retirement account, including that typically the 10% penalty is waived, and also some additional information on how that would be typically included in income over a 3-year period. So again, we're a little ahead on the tax layer ability to go ahead and report these activities, but the traditional methodology would this actually not only be exempt from penalty, but by default would be spread over a 3-year area of taxation.
Okay, thanks for that. Next question, is inheritance taxable on state?
Fortunately, it is not. It is not taxable for state or for local purposes. So inherited activities, inherited assets are not taxable for state or local purposes.
Okay. I think you may have covered this. I'll ask it regardless. I'm told the penalty is not waived, but you have 3 years to pay it off. This is regarding the COVID.
Right. So typically the 3-year repayment would also apply if you are considered a qualified distribution. So the distribution should be a coronavirus related distribution, which would allow you that 3-year repayment. So that's generally where we come from. So typically you would have to be eligible for the penalty waiver in order to also get the 3-year repayment schedule. So they're not going to give a benefit for someone who had just taken money out of the account for any purpose and still get a 3-year repayment. It's generally going to be a coronavirus related distribution. So typically you would be eligible for penalty relief and a 3-year prospect there of repayment or inclusion in income, I should say.
Okay, thanks for that. Next question, this is regarding alimony. Is there legal documentation provided that indicates that a person is receiving alimony payments, or do we just take the word of the client?
So there is actually no official official process here of how we would go ahead and information about the alimony. Typically, it's going to be from the word of the client. It's going to be how much have you actually had in alimony. So unlike child support, where we may see a form from the state, there's generally no documentation about alimony itself. So that's typically going to be on the word of the client. One area of item I'd like to just point out is typically the best source of information is to go ahead and take a look here and see did they actually report it on the prior year return. So take a look at the prior year return and see if alimony is there. If it is, then we probably just want to have an indication of whether or not that alimony continued, because some people may be mistakenly under the impression that alimony is no longer taxable. That's not the case. It's only no longer taxable if the divorce was completed after that December 31st change, or there was a substantial change in the divorce agreement after that date and time. So typically take a look at the prior year return, see if there was alimony. Another way that we could also get this from the client is to indicate that the IRS doesn't always get everything right, but they're very good at matching alimony deduction with alimony income. So if the payor is actually deducting alimony payments, indicate the Social Security number of the recipient ex-spouse. The IRS will match that up to make sure that ex-spouse's returns reporting the same amount of income or greater on their return. So it is an area the IRS does match up fairly well. So if we have alimony in a prior year, we just probably want to double check and see if it's continuing for the current year.
Okay, thanks for that. This is a follow-up on the COVID reimbursement, refunding. If the penalty and early distribution is waived due to COVID, but the funds must be replaced within 3 years to avoid taxation, you may have said this is out of scope, but would we then inform them we can't do the return because we'd be calculating tax they potentially could avoid if they're going to reimburse the funds?
Yeah, so this gets to be an interesting one, and it may be something that we end up at VITA discussing the best way to handle these situations and potentially as they arise. So we have two kind of interesting, unique elements with these COVID-related distributions from a retirement account. One is if they're qualified COVID distribution, the penalty will automatically be waived, and the general process and taxability is that it will be a area where we're looking at a ratable inclusion over a 3-year period. So that's default. They can actually go ahead and elect to include it all in the current year if that makes sense, if they believe that their tax rates will be rising or some other issue. Gets to a lot of planning. The issue we run into is if they repay these amounts, and again, they have up to 3 years to repay the amount, we don't really have that information up until the date of return. If they're going to plan to repay this in later years, the issue is we may have to go back and amend the current year return. So I think it's more of a policy question here, probably of how Lancaster VITA would like to work with that. It does open up a whole lot of additional issues of having to go back and amend returns. It's something we could probably maybe talk about a little bit more. I'm not quite sure, Jeff, your thought, Michelle's thoughts on how we would want to progress with that. Typically, the recommendation from the IRS is if we're looking at a situation where the client wants to repay, it's probably going to be a little bit more involved and could span a couple-year period. So as long as you're willing to work with us for that period of time, we might be able to do it, but technically it's out of scope.
Understood. Yeah, so we'll take that up and just advise the team on it.
Mm-hmm.
Okay. Is there a penalty if there is a penalty for underpayment taxes, the penalty for underpayment for local taxes, then it's Slayer, or is it only tracked at the local tax authority website? TaxSlayer shows the estimated tax payments for next year for state and fed, but is there also a place to put them in for local?
That's a good question in terms of TaxSlayer generating the estimated payments. I have not personally done that within TaxSlayer to see if we can set up the estimated payments within the TaxSlayer program or if that has to be done outside. Yeah. I know that TaxSlayer probably will not automatically calculate an underpayment penalty for local taxes. That is generally something that we would have to do by hand. There is a calculator available for both state and local to calculate penalties and any interest for underpayment, but that will typically not be automatically included within TaxSlayer.
Yeah, but there is a place.
And just as a follow-up, why don't we address that when we get to the local section? I've never had a client that has estimated local taxes paid, but we will get an answer and cover that in the local area.
Sounds like a plan, Michelle.
All right. Next question. This year, we may see more Schedule C business loss. Will you be discussing that?
We will be talking about that. Now, unfortunately, a business loss is technically out of scope for VITA. So, again, probably a policy question. I'm not quite sure how that impacts the ability to have returns prepared this year. But one of the areas that the IRS is fairly clear on is that we cannot generate a loss with the Schedule C within VITA. So I would defer probably Michelle, you and Jeff, if you wanted to opine on that position.
Yeah, that's correct. That is our position, that we aren't doing losses.
And that's one of the screening questions that we ask as they're setting up their appointments. If you expect to have a business loss, we cannot serve you.
Perfect.
Okay. And that was all we have for questions.
Okay. Fantastic. Just want to double check that. Are you able to still see my screen here?
All good.
All right. Perfect. We will go ahead and continue out. Like I mentioned, we have a couple of slides to go through here yet. We will go ahead and be able to take questions again. If you have any additional questions, feel free to put those in chat. And we will wrap up in a couple more minutes here, be able to address any additional questions. And certainly, we will hold a couple questions for state and local and for deductions next week as well, but want to make sure that we are getting enough information here on the income side. A couple other areas we just wanted to mention are in terms of capital gains or losses. Again, because we're looking at the advanced certification, these are in play for all of our volunteers this year. Traditionally, where we're going to be seeing these are coming through brokerage statements. Traditionally, those are going to be our sales of stock, sales of mutual funds, and sales of a principal residence. Those can those be the areas that were in scope of VITA. Where these end up on the 1040 is actually on the forms 8949, which ultimately then flow to the Schedule D, which then come up to the front part of the 1040 and become taxable income at that point in time. A couple things that we just want to point out that are needed in terms of our activities for reporting capital and gains and losses appropriately. We need to get the sales price. So usually that's reported, particularly if we're getting information from a broker. The one area that we run into a little bit of trick on occasion here are these, I just want to point out, I'll use my stamping tool here, this adjusted basis of assets. Oftentimes the brokerage statement should generally have the adjusted basis of asset already included there. In most cases that the broker is required to disclose the amount of basis in an asset. If the basis is not provided, our general rule is to go back to the taxpayer and ask if they know what the basis is, or suggest that they contact their broker for them to calculate basis. There's some additional information in publication 551 on how we can go through about requesting basis or how it's calculated. I will warn you that the IRS, if we cannot identify an appropriate adjusted basis of the asset, will come up with a number themselves. That number, unfortunately, is zero, that they will assume that you paid nothing for your asset. So just something we want to keep in mind as we go through the process. We probably want to be sure that we can get that information from the client. Again, we cannot create that. So one of the things that we are going to be taking a look at here from that aspect is we would generally go back to the taxpayer to see if their broker can provide it. Oftentimes, even if it does say unknown or not available, the broker does have some information on what that looks like. So they generally can provide a number. Again, as long as that number is provided to us and it seems reasonable, we can go ahead and take that. Some other things we'd be taking a look at would be understanding how long the security or investment has been held. There is a very nice benefit if you've held your asset for more than 1 year. It can be considered a long-term property, and at that point can actually get down to as low as a 0% tax rate for that asset. We also want to know if there's any capital loss carryovers. Again, taking a look at a prior year return is going to be very beneficial. Some things that we would take a look at there would be to see if we have a capital loss carryover coming from a Schedule D from a prior year, or take a look at the return and see if they've deducted up to the maximum $3,000 capital loss for the year. Anything in excess of a $3,000 capital loss will actually carry forward indefinitely for the life of the taxpayer. A couple other things we take a look at would be the opportunity for a principal residence exclusion, which can come into play as well. So if typically we'll probably see most individuals within VITA qualifying for the principal residence exclusion. It is a fairly high number, and we'll go ahead and take a look and see how that'll come into play here as well. Now, typically we don't normally report our sale of a principal residence. Usually when you go for a settlement at that case, they will not issue a 1099-S. If there's no 1099-S reported, which is for sale of real estate, we do not need to go ahead and report the sale of the property and go ahead and put it through the 8949 and the Schedule D, unless either we get a 1099-S or that the home does not qualify for the exclusion rules. But typically where we're going to see the sale activity is coming through on a 1099-B. Typically that's going to be coming through from our broker statements, or we're going to be getting some other activities here for the 1099-S if we have real estate. I don't think we're going to see a whole lot of 1099-S's, but if we do get one, we do have to report it on the return. Again, the IRS will match these forms up, and if we don't report the information, the taxpayer will get a notice at some point in the future. So a couple things we want to take a look at are, again, the basis information, very critical. That's the original cost of the asset. However, that can be impacted with any things like commissions or fees, things that they've actually paid in order to acquire the asset. Again, typically the broker is going to report the cost or other basis on that 1099-B unless they meet the definition of a non-covered security. So you may take a look if you have a complex brokerage statement. They usually will divide the capital activity into short-term, long-term, and then they'll generally do a covered or non-covered. The recommendation we have for VITA is to, if we have that summary data, to go ahead and report it in those subcategories. So if we have a short-term covered activity, go ahead and report all the short-term covered securities as one figure. If we have long-term covered, that becomes another area, and a long-term non-covered would be a third area. So if you don't have a whole lot of transactions, you can go ahead and use the individual entry. However, again, because we have a lot of sometimes sales of these securities, if it's summarized appropriately, I believe the position within VITA is we can go ahead and enter the summary data itself. That way we prevent a lot of issues of going back and double checking to make sure we didn't have any typing issues or things along those lines. Again, a couple things we just want to keep in mind. The holding period here is anything 1 year or less is considered short-term property. Long-term is anything over 1 year. And if we have a long-term capital gain, those can be taxed at a lower tax rate than short-term capital gains. Short-term gains are going to be taxed at ordinary income rates. The lowest one we have is 10%. The lowest rate we have for a long-term gain is 0%. So if you have a taxpayer and they have a substantial amount of long-term capital gains or qualified dividends, don't be too concerned that the tax return is going to show up with no tax due. Those can actually be subject to a 0% tax rate. So that's one thing we take a look at. Okay, and just wanted to point out, just saw a quick question come through chat on the covered or non-covered. So that is actually a determination that the broker is going to make as to whether or not these securities are going to be considered reportable for basis purposes. That's effectively what a covered security means, is that the stockbroker is required to report basis to the government. So if we see a covered security, it means that basis amount's already been submitted to the IRS. If it's non-covered, it means that security has fallen out of the regulation for reporting basis to the government. That's essentially what a covered and non-covered area would be. Okay, so just wanted to mention about that sale of a principal residence. Again, you'll find that on a D28. Typically, again, as we mentioned, if we do not have a 1099-S and the taxpayer met all the rules for exclusion, we don't need to report it. However, it does need to be on there if they either don't meet the exclusion or they got the 1099-S reporting the sale. Just a couple pieces of information that what we have here are for the sale of a main home. Just a couple quick rules: that the property has to be the home in which the taxpayer spent the majority of their time. It has to really be a principal residence. That's what the definition is. The interesting part of the rules is that you've had to have lived in the home and owned the home for 2 of the last 5 years. These do not need to be at the same period of time. The IRS loves to come up with these bizarre examples of how someone may have lived in a home. They lived in the home for the starting 5 years ago, and then they decided to buy the home, and then they decided to move out of the home and rent the home for part of the time, or let their children live there or whatever else. That still counts. They do not need to be simultaneous use and ownership, but you have to have at least 2 of the last 5 years of use and ownership for the exclusion account. The benefit here is it does allow for an opportunity for someone who may have downsized. Maybe they're living in a retirement community and it takes them a little while to sell their home. Although here in the central PA region, homes are moving quite quickly, so hopefully it's not taking 3 years to sell your house. But those are the rules. As long as you have lived in it and owned it for at least 2 of the last 5 years, you can qualify for the exclusion. And we're pretty comfortable that most people within VITA are going to qualify under the exclusion rules. It's $250,000 per taxpayer, or $500,000 if you're married filing jointly. So that means if your home is sold for $240,000, if you're single or married, it doesn't matter. If you met the 2 out of 5 year test, it is not taxable. It is fully excluded from income. Now, if for some reason we're running above that, we can determine the gain from the home. Selling price is going to be the total amount that they receive for the home. Usually a HUD-1 would accompany that. That'll show the total amount of the sales of the home. We'd want to take a look at how much we have in selling expenses. That would be any commissions, any of the advertising fees, legal fees, a lot of those settlement costs on the back. The basis for the home would be whatever the taxpayer paid to buy it or build it or substantially improve the property. So that includes any additions, any improvements, anything that they put into the home. So generally, again, we're not going to really anticipate a lot of gains on the sale of a principal residence, again, because if they meet the 2 of 5 year test, it's a relatively high threshold for the exclusion. Moving over to a couple other areas, I just want to kind of touch on business income a little bit here. Again, additional information will be found on D17 of your 4012 that will be reported on the Schedule C. One thing that we see here again is our qualified business income deduction. It's an automatic 20% deduction off of your Schedule C business income. So that will automatically calculate for you. There's no additional information that you should need to do within TaxSlayer to get that to work. Couple things that we want to remind you about the scope issues for VITA is that we cannot have greater than $10,000 in business expenses. We cannot have a loss from the business. So I know the question had come up earlier, but that is out of scope for the VITA program. They cannot have employees. They cannot have returns and allowances. Again, that's kind of taking a look at the next item of cost of goods sold. So we cannot have inventory. So you cannot be running a grocery store, furniture store, things along those lines that actually have inventory. We do not handle farm returns. We do not handle things that require depreciation. The home office also is not applicable for purposes within VITA here, so that does not apply. There are some specific rules with depreciation, so a home office typically would not work. And again, we do not typically work with the self-employed health insurance deduction unless it's coming through automatically on a position like Social Security or something else. Again, as Michelle mentioned, when the taxpayer is setting up an appointment, they're typically going to be asked for this information, but sometimes they will slip through. So in case we do run into those issues, we just want to be aware of what those would look like. Again, if we run into these situations, the return is a lot more complex. And what we're also going to recommend for our clients is that they are going to go ahead and provide us the summary information. We do not need to go through and calculate their returns for them and adding up all the receipts. We would be expecting them to provide the information to us that will list those out. And I'll go through the expenses in just a minute. One other thing I did want to point out here is for the business income, and I know we had that question earlier, we will be seeing a brand new form for 2020 for non-employee compensation. This is now going to be called the Form 1099 NEC for non-employee compensation. The amount that the taxpayer is receiving for non-employee comp is going to be on line 1. So that's going to be a brand new form. We would anticipate most of our clients should now be receiving the 1099 NEC. The 1099 miscellaneous is still going to be used for a couple other items for being reported. Those predominantly at this point would be a situation where you'd have rental income or other income like prizes or rewards or things that we know are not subject to self-employment tax. As a reminder, rental income is not in scope for VITA. So if you have rental income, if you're renting out property, it is not a return we can prepare within VITA. So again, this should be coming into play within TaxSlayer once it's finally ready to go for 2020. It's not currently there now, and your 4012 is also probably going to be having an update coming through. Usually we see these in correction and new iterations by the end of the year, so we're anticipating that'll probably come through at some point where we'll get some more information on that 1099 NEC. This should make it a whole lot easier. We're not going to see, obviously, the 1099 MISCs anymore, where you have to go look at box 7. This should be much clearer in terms of business income. You can actually link these 1099 NECs to a Schedule C, make it a little bit easier. So a couple other things we wanted to talk about here in terms of business expenses. Again, the whole listing will be on the D18 of the 4012. Some things that we would take a look at for things being within scope for VITA. Again, these are the ones that are actually pre-listed on the Schedule C. Things like advertising income, we can use standard mileage for car and truck expenses, any commissions and fees that are paid, things like business insurance, interest that we're paying on things like equipment or business line of credit, outside legal and professional services. Again, office expenses, these would be things like your stationery, inks, that type of thing. We do not do office and home, so that is not allowed for a deduction. If we have to rent or lease machinery, equipment, that type of thing, if we have to rent a car, or if you are a painting service and you have to rent ladders or scaffolding, those would be deductible. Things like repair and maintenance, supplies, taxes, licenses. If you travel between work location, if you have meals, those have to be directly related to business. So grabbing lunch while you're working is not a business meal. But taking a client or potential client out for a meal could be deductible. They are subject to a 50% limitation. Utilities for businesses can be used as well. Just bear in mind, do not try and write off the full cost of a cell phone if the cell phone is predominantly used for personal purposes and not business. The IRS is somewhat lenient on those, but they do take a look at business use to ensure that at least 50% of your calls and activities are used for business purposes before we write off cell phones. One other item I do want to point out is for Uber and Lyft drivers, even though we're in a coronavirus situation, we are still seeing that people are still having driving services. They are considered independent contractors, which is that non-employee compensation. Again, as we talked about last week, you have to file a tax return if your net earnings are greater than $400. That's our threshold for filing for self-employment taxes. The income is going to be reported to our drivers on the Form 1099 NEC, again, the brand new non-employee compensation. These are for people who are working, who are considered self-employed. They are not employees. They do not get a paycheck that has withholding. They do not have a W-2 at the end of the year. They are considered independent contractors. They could also get a Form 1099-K. This 1099-K is actually a detailed listing of any amounts that they had received from credit card processing services. Either one of these are going to be reported on the Schedule C. For Uber drivers or Lyft drivers, typically they're going to have their car and truck expenses based on standard mileage rates, any of their commissions that they have to pay for using the service or credit card service fees. If they get additional insurance that they're purchasing specifically because they're driving, if they have purchased a car and they have a car loan, the interest on the business portion of the car loan can be deductible. Again, office expenses, we shouldn't really expect a whole lot of office expenses, but things like some of those paper and ink, again, could be deductible. If you have a things like a logbook or things you may keep manually, that could work. Supplies, these include items that you provide for passengers. Those are including things like bottles of water, mints. They can include cleaning supplies and any of utilities. Again, taking a look because you're required to use a cell phone, we may be able to take the business portion of a cell phone. Traditionally, the Ubers and Lyfts, if the client logs on to their page, it will provide them things like their mileage, how much they've driven, how much they have paid in fees, that type of thing. So often we can get that information directly from the client. Again, a couple changes for self-employed individuals due to COVID. We are including this because there is a question in the certification exam about deferring self-employment taxes. There are actually two different elements here. One is H1, which talks about this deferment. H9, not really within scope of VITA, but it is applicable for 2020, is the ability to create a effectively a sick day or sick leave for self-employed individuals. Again, I don't think that's going to be applying for many situations here in VITA. Those are much more limited than we had for those distributions for retirement accounts, but it could potentially be applicable. But again, not on the certification exam, so we wanted to try and see how many of those come into play before we throw even more odd rules at you for training. One of the main changes we had is for self-employment taxes. They actually can be deferred until 2021 and 2022. That's only on the employer's share. So one of the things we want to take a look at very clearly here is that this only applies on the employee's share. I'm sorry, the employer. So only half of that Social Security can be deferred. The other half is going to be payable. It's only on the employer's share. If that is deferred, that election is going to be made on the Schedule SE. So take a look at the page H1 in the Pub 4012. It walks through how that would occur. It only applies for any of the income earned from March 27th through the end of the year. So that's only going to be from March 27th through December 31st. You can allocate your income. The IRS is fine with using a days allocation methodology, but just want to point out that we could have the possibility that we have an election. So again, you have to elect to do this to not pay the employer's share of Social Security in the current year. Bear in mind, it's not forgiven. It has to be paid over the next two. So it's something we can work with. I think we'll probably have some more discussion with VITA if it's something that we are encouraging our taxpayers to do, or whether we allow them to make the commentary first. So again, some COVID-19 changes. A couple other things I just want to mention here about some other income, gambling winnings and other income. We're seeing a lot more opportunities for gambling winnings, even though the casinos were effectively closed down or closed down for a bit due to COVID-19. We're seeing quite a spike in online gambling platforms. Gambling winnings are taxable. They are reportable on a Form W-2G. If you do have a W-2G, you can actually go under the federal section income, less common income, and enter specifically gambling winnings. It's a specific line item in TaxSlayer. If a taxpayer does have gambling losses, one of the things we often hear is that, oh, I have winnings, but I also have a lot of losses to offset it. The downside is you can only deduct losses to the extent of your winnings, and only if you are itemizing deductions. So any gambling losses are actually reported on Schedule A as an itemized deduction. So if they cannot itemize, if they're going to take the standard deduction, they do not receive benefits for the losses. Other things that we may see under other income, again, other income not reported elsewhere, things like jury duty pay, things like gambling winnings that they did not report on a W-2G. Maybe it came through a different source or they self-disclose. That would be reported under other income. Other income not entered elsewhere. As a reminder, we may still get a 1099 miscellaneous for prizes and awards. That would be in box 3. Again, not subject to self-employment income, but would be considered other income subject to tax for federal purposes. And D52 will be the spot in the 4012 where we will have that information. One other area we do want to just cover, again, as we take a look at debt cancellation, one of the areas that we need to address is that if an individual has borrowed money and those debts are canceled, that may be subject to income tax. What typically happens is a taxpayer is going to receive a 1099-C if they have a canceled debt greater than $600. Now, this can arise from a variety of situations. The most common one we'll probably see within VITA is for individuals who have gone through the debt cancellation or debt consolidation services, that now the political ads are done. They'll be popping back up again on TV, radio, and billboards. But traditionally, if a client's gone through a debt cancellation process and it's more than $600, they're going to receive a 1099-C. This would be reported to the IRS. So we need to make sure that we have this actually listed in our TaxSlayer program. Now, what is within scope for VITA? Well, it has to be personal debt. So not business debt, it has to be personal debt. Traditionally, what we're looking at here are things like credit cards or potentially a vehicle loan, something in a personal debt. It has to be reported on a 1099-C. There is no interest in connection with that. Typically, we don't see that in those circumstances. It's just really the level of debt. It's the actual amount of debt owed, no interest related to it. Again, it cannot be business related. The individual is not under bankruptcy, and typically they're not going to claim the insolvency exception. We'll talk about that under D60 here. If that applies, if they're not claiming insolvency and it's personal debt, it's 1099-C, then all the income is taxable, and it's going to be reported on Schedule 1, Line 8 of other income. So the amount of debt cancellation will be reported as other income. Now, the one area that we do want to kind of briefly mention is that there is an insolvency exemption. So if the taxpayer has had a debt, but they are effectively owe more than what they have in assets, that could lead to an insolvency exemption. That is covered on D60, but not something we typically work with within VITA. So again, probably a situation if it arises and it made it through 211, you'll probably want to talk to your site coordinator or others about the best way to handle that situation. All right, so that takes us through our expanded version here within VITA for income. So we'll go ahead and turn it back over to our host, Jeff, for questions and commentary. So feel free to have those keep coming in via chat, and we will do our best to answer the questions that you have here.
Okay, thanks, Jared. Thanks for presenting all the material. The first question I have is VITA doing returns for businesses that took PPP loans? If so, how do we determine expenses that are covered by the loan amount and those that are not?
Great question. So traditionally for PPP loans, the businesses that end up qualifying for those are ones that traditionally, if you take a look at the PPP, it's a paycheck protection program. So if a business has employees, we will not be doing returns, whether it's a Schedule C or anything else. So if they have employees, we are not going to do those returns. They're outside the scope of VITA. If an individual has gone ahead and has applied for a PPP loan as a self-employed individual, the rules are relatively straightforward about debt forgiveness. That's not an area that VITA ourselves will get into. The PPP loan forgiveness is starting currently. They should be in touch with their SBA lender. Their SBA lender should be providing information on a simplified method for them to have PPP loan forgiveness. If that is only applicable for the amount of the self-employment draws, then there's nothing we need to worry about. If they are using other expenses for purposes of their loan forgiveness, those expenses are no longer deductible because they're getting tax-free income. So it raises a fairly complex question of how we deal with those. My belief is we probably will not see a lot of clients coming through VITA with PPP loans. They are a little bit more involved in process, but theoretically, if we do see that, we should probably be asking the question if they have loan forgiveness and if they use any expenses to document the forgiveness of loan. If that's the case, then those expenses will not be deductible. However, the majority of those expenses are things like business rent, mortgage payments on a business location. So I'm not anticipating we're going to see a lot of those coming through. But again, probably something we'd want to address from a overall program perspective. So Michelle or Jeff, I didn't know if you had any additional commentary on the PPP at this point.
So my position would be that, number one, I don't think we're going to see many. And if you do, I would reach out to Jeff or I just through the hotline to make sure we handle it properly.
Okay, thank you both. Next question. Some broker statements have 40+ transactions. How much may we consolidate transactions?
Yeah, and as we kind of mentioned with the stock area, I generally recommend that you break it down by subcategory. And Michelle, I just want to confirm, is that the position you're still taking with VITA, that between covered and non-covered, short-term and long-term?
Yeah, at most we would expect 4 entries.
Yep, okay. Yep, so that's typically how we would go about it. And again, fortunately, the covered securities, we're going to see a lot more in the covered. Again, those are the basis areas that have to be reported to the IRS. So most brokers are pretty good about doing the reporting of basis. So hopefully we don't see a whole lot of basis unknown. And again, if we do see those can go back to the broker to get that information. But typically we would just allocate it to say, if it comes from, Lancaster Bank, you can put in Lancaster Bank short-term securities, put in the code A, and just summarize those transactions. And again, like Jeff mentioned, probably only 4 entries you need to make. And you don't have to go through every one. I have seen the ones where they have pages and pages of detail. Not a typing exercise here in VITA to see how well you can transcribe numbers from a form to the return. So summary is always welcome there.
Okay, thanks. Is there a way, sorry, there was a question about covered versus non-covered. I think you handled that already. Is there a way to see if a 1099-S was issued for a given property address?
The 1099-S should be issued to the seller of the property. So if they did not get one, then it probably was not issued. They are very seldom issued because if the settlement agent knows it's a principal residence, they will not issue a 1099-S. And I'm not quite sure how many times we'll see a HUD-1 coming through from a client, but usually it'd be part of that whole packet they get at the settlement. But it may actually come in after the fact. So traditionally, I have not seen a lot of 1099-S's unless the settlement agent knows it's not a principal residence. For example, it may be an inherited property. Perhaps a child is selling a property on behalf of a parent that had recently deceased. That's where I typically see the 1099-S's. So I'm not quite sure how we would verify that a 1099-S was issued. If we do run into a scenario that a 1099-S was issued incorrectly, and we were not aware of it, it's actually a pretty quick remedy with the IRS to explain that the principal sale rules were applicable and that there was nothing in taxation.
Got it. Thanks. The next question, just confirming, does TaxSlayer recognize foreign tax credit for dividends on international investment?
It does, yeah, and we'll cover a little bit of that next section, but yeah, so typically those brokerage statements, particularly where you have a mutual fund or maybe stock investment in a foreign entity, the foreign tax credit will automatically flow over and be taken on account, and I believe it actually avoids doing the whole Form 1116, so you don't even need to worry about doing that one. As long as you meet the criteria, it should automatically calculate and flow over for the return.
Okay. What if someone sold primary residence that they own for only 2 years? Is that still excluded?
Yeah, so as long as they lived in the property and owned it for 2 years, so it only has to be 2 out of the last 5. So as long as they met that 2-year rule, it's still going to be excluded.
Okay. If you start a Schedule C, and what do you do if you start a Schedule C and then see there is a loss?
Question. I think that's probably a little bit more of a policy question of how you guys would like to handle that.
So in my experience, go ahead, Michelle.
No, Jeff, go finish.
We stop the return and tell the taxpayer that, or the client that we can't help them.
All right.
All right. Can a taxpayer own a home jointly with a child and still exclude?
They can, yeah. So what we sometimes see here is that for estate planning purposes, they decide to put a child on a deed. So it still could be excluded. What we'd take a look at here is probably depending on the sale price, it certainly would apply for the person who lived in the home. Some of the recommendations we'd have from an estate planning perspective, again, we don't get into a whole lot of estate planning issues with our VITA clients, but one of the cautions we have is making sure that we have the titling correct for the property. But yeah, so if the taxpayer does own a home jointly, they can exclude it. So they would be entitled to, if they were married filing jointly, they would have a $500,000 exclusion. If they're single, they would have up to a $250,000 exclusion.
All right. Please define non-employee compensation.
Okay. So non-employee compensation would be income earned as a self-employed individual. So non-employee compensation, where we'll typically see the 1099 NECs coming through, would be something along the lines of if you're working part-time for a company, certain things like a cleaning service, lawn mowing service. It could be if you work as a subcontractor for a construction company. If you're an Uber or Lyft driver, if you are doing, say, property management work for a company, they would typically issue a 1099 NEC, which is a non-employee compensation. So one area we're going to know that someone's self-employed is because they received a form from their payer. The other way we would do that is because either on the intake sheet or because they're volunteering the information is we know that they have self-employment income.
Okay. Do Uber drivers have to pay self-employment taxes, i.e. Social Security taxes? Yes,
they do. So Uber drivers, Lyft drivers are considered self-employed. I know there's some legislation occurring out on the west coast of our country in California that they're trying to consider them to be employees. That has not been adopted yet. They are self-employed individuals. They get to pick and choose when they drive, if they decide to take a fare or not. So it is considered self-employment, and they do owe Social Security taxes. Unfortunately, even though the drivers sign up and that information is listed in their application, you may not recall that when it comes time to pay taxes, and they end up owing some more money than what they had initially anticipated.
Okay, thanks for that. Next
Yep.
question. If student loan is canceled through IBR or repay, is that counted in a similar way like a 1099-C? And then a follow-up, would recommend they consult with MidPenn Legal for a potential resolution.
Yeah, so student loan interest, there are a couple things that we would take a look at if it's canceled through a authorized program. We have a couple areas that you can have debt forgiveness by completing certain elements like required government service or a few other things. That is a different situation. We typically would not see a 1099-C in that context, but if there's some other kind of debt forgiveness for a student loan, then it would be considered eligible for reporting on our VITA program. These do get a little bit more complex, so certainly if we run into some issues in terms of large amounts owed, or in terms of maybe additional discussion on debt forgiveness, I think that would be a prime example, I believe, for MidPenn to utilize their services.
Got it. All right, thanks. Next question, are COVID checks, stimulus checks considered income?
No. So if individuals had received the economic the economic payments last year, the EIPs, those are not income for purposes, even if they were issued based on a prior year return and the current year return would make them ineligible for the EIP, they still get to keep the stimulus checks. It is not considered income. The only situation that they cannot keep the EIP is if they had died effectively before they received the EIP. In that case, those amounts are required to be returned back to the government.
Okay. Do we need to worry about FIFO or spec ID for stock sales and cap gains, or will that be already figured out on the brokerage statement?
Usually the brokerage statement is already going to go ahead and indicate the methodology used for basis calculations. So we don't have to go through and redo any of those calculations. In fact, from a timing perspective and really from a VITA standpoint, we don't calculate basis. So we don't have to go through and do that calculation. That should be coming directly from the broker, or that they've already made the election with a client of whether they're using FIFO or some other type of methodology for basis calculations, particularly with mutual funds.
Okay. And then this last question, this relates back, I think, to Schedule C losses. What percentage of time does VITA say we cannot serve Schedule C losses? It sounds like tonight there could be more situations. So I know we had indicated that 2-on-1 does a screening. I don't know if they keep metrics on how many clients that we have not been able to help without even starting the returns. And that's also screened on our website when clients self-schedule. So Michelle, I don't know if you have any information on that.
We don't track the number of times that we cannot serve clients. People who fall out through 2-on-1, I don't know what number that would be, but I think through our program, it's very, very few that we end up not being able to help.
All right, thanks for that.
I would probably add there, Jeff, even though we talked about a lot of things that are excluded tonight, really, I don't know that we're going to see a lot of differences from prior years. Usually with self-employment income, unless it's an active business, usually most of our clients actually have profit from self-employed activities. So whether it's something like kind of childcare or lawn mowing or things like that, the IRS is not expecting a lot of losses from self-employed businesses. That's generally when someone is full-time running their own business operations. So generally, we don't see a whole lot of those coming through VITA, particularly because we don't work with inventory, we don't work with employees, and we don't have certain deductions like depreciation and things like that. So I don't want to scare anyone and think that all of a sudden we're going to have a lot fewer returns coming through this year than we've had in the past. In fact, if anything, I think we may see a little bit more as people are now having some questions or concerns about the economic incentive payments, the unemployment compensation and things like that. So I think we'll actually see a little bit of an uptick here in some of these areas of VITA return within scope.
Okay. If someone does not receive their $1,200 stimulus, how do they claim it?
All right. So if for some reason that they did not qualify for it in 18 or 19, based on those returns, one of the prime examples that I would probably use in that context would be someone who was a dependent on an individual's return in 2018 or 2019 would not be eligible to get their own $1,200 economic payment. That will be eligible on a 2020 return. That is unfortunately one of the areas that we don't have updated yet within TaxSlayer, nor is it updated in the 4012 about the EIP process. That is something we'll be talking about as we move between now and the start of the season, about how we can actually verify how much clients had received an EIP and whether their circumstances have changed. For example, the maximum amount is $1,200 per individual, but if their income for whatever reason was a little bit higher, now generally within VITA, because of our income thresholds, generally the people within VITA, if they're having their returns prepared by us, already fell underneath the income thresholds. Remember, it's only $75,000 and $150,000 for married filing jointly. So based on our income limitations, anyone coming through VITA should have already met those qualifications for income. But if something changed, maybe they're coming into VITA for the first time and their income's fallen, they can get the balance of their economic payment when we file the 2020 return. We're going to have knowledge of how much they've already received, and that will come into play once we have the information available from TaxSlayer of how that'll be calculated.
Jared, if I can also add, one addition that we'll have is anyone who had a new child during tax year 2020, they would not have received the $500 for that dependent in their EIP, but they will be able to collect that on their 2020 tax return when the IRS knows that there was a new addition to their family.
Correct. Great point, Michelle. The other thing I want to point out is technically there has been talk of another stimulus round coming through potentially. Been in the works since July. Some of you may be aware that there's still a little bit of turmoil in Washington. I'm not quite sure when the government's going to get back to dealing with some of these issues of economic stimulus payments. But that was something on the table before everyone broke for the fall elections. Still may be something that we'd see between now and the end of the year, depending on how things calm down or not calm down, as the case may be in Washington. But we may see another round coming through. So we just want to kind of deal with these as they arise, and we'll certainly keep you abreast of any new changes with kind of the payment structure and what that would look like for the 2020 returns.
Okay, that was all we have for questions. Thanks, everyone.
All right.
Okay, so just to wrap everything up, I'd like to thank everyone for joining us tonight. I do apologize for the technology difficulties on my end. We will be sending out the recording tomorrow, so you'll be able to listen to any of these sections that you want refreshed on. And then next week is tax law number 3. We'll be covering credits and deductions, and that will be next Thursday at 5:30, same time. So I'd like to say again, thank you for joining us. Have a great rest of the evening, and please let us know if you have any questions, and we'll talk to you soon.